Malcolm Ethridge is here with our trades today. He's CIC Wealth Management's Executive Vice President and a CNBC contributor. Malcolm, it's good to see you. Let's begin with McDonald's, grappling with those value meals they're rolling out while franchisee costs and perhaps frustration are rising. The shares are higher today, but they're down 14% year to date. Are you a buyer here?
Yeah, Kelly, I actually think this one is a buy. I know a lot of the attention, like you said, has been around the $5 meal deal. You got the folks on social voicing opinions on whether this should become a staple rather than a temporary promotion. You've got the franchisees who are concerned about how this is going to impact their bottom line. But I think the thing that makes McDonald's an attractive stock right now has nothing to do with the value menu. It's their forecast to grow restaurant count by 4 to 5% over the next 5 years, because that translates to what that translates to is the upfront fees that they collect from each of those franchisees each time they sign someone up, plus the 5% each year that they're collecting as their revenue sharing.
All right, let's move on to Gap. We did a big segment yesterday about the return of denim. Shares are up about 25% as earnings beat on sales growth at all 4 of its brands and raised its full-year guidance. What's your trade on Gap? It's been kind of in the revenue doldrums for several years.
I consider me a skeptic. I rate this one a sell. I know that shares of the Gap have performed well over the last maybe 6 months or so, but year-over-year growth is still negative, right down more than 6% in fiscal 22, down another 5% in fiscal 23. And I know they're guiding for better margins in fiscal 24, but for a company that's currently trading at about 16 times, I think now, times forward earnings, that's concerning to me when you compare that to other competitors like American Eagle, which trades at about 14, Urban Outfitters trading at 11.5. Gap's not a better run company than those guys, which means it's trading at an unrealistic premium here.
Interesting.
Unrealistic premium. All right, let's get to Ulta Beauty then. They were also reported earnings yesterday showing the effects of a slowdown, with the CEO outlining plans to boost sales. Shares are slightly higher, but off the best levels of the day. This was the winner of the 2010s. What do you do with it now, Malcolm?
So there was something that was discussed in the Ulta call that actually got me interested in this one. I know they had a tough start to the year, to put it mildly, but I think the big attractive buying opportunity setting up here is where they talked about plans to expand into Mexico, right? The reason that's significant is because there's not a dominant beauty brand there yet. Sephora just entered that country a couple years ago, and Ulta has some of the most loyal customers there are in that category. So down about 30% from their most recent high. I think investors in this name are getting a chance to buy into that expansion at a decent discount.
Well, there you have it.